Hi everyone, welcome to Market Mondays. This is Jarek, your host for today. What a good news for this weekend. There's good news coming from US-China trade talks for Trump and Xi to meet later this month. And we also have quite a few good news on MAS. Coming up with value-up reforms in Singapore to help to improve communications between companies and also for them to market themselves better. So what we have for today, we have 3 to 4 items. The first item will be that Thilan came out with a market up, value up reforms report, which will show you the beneficiaries of potential beneficiaries of the value up reforms coming up from MAS. Next, he will also share more about the upcoming preview of the banks who will report their results next week. And then next, we also have Hussaini, who actually downgraded C last week, and we will ask him why on the downgrade. And lastly, we have Marco Polo Marine, which we upgraded our target price last week as well. And I will share more on Marco Polo later. So we'll start with Thilan first. Thilan, thanks for coming on the show. First, MAS is expected to unveil market value reforms for Singapore in November. You have identified 33 stocks that could benefit if this happens. Can you share the main points, lessons from other countries, and how can this play out in Singapore?
Sure, thanks, Derek. So I think Singapore's small and mid caps have actually done well this year, but longer term re-rating really hinges on structural value unlocks and not just merely liquidity injections. If you look at MAS's reform so far, they prioritize market liquidity with their 5 billion EQDP program and listing simplifications. Now, these measures have been successful. If you look at the MSCI Singapore Mid Cap Index, that's up about 22% year to date, while the STI is up about 16%. But to sustain this sort of re-rating, we believe Singapore must emulate the North Asian, capital market frameworks that can drive capital efficiency and shareholder alignment. Now, Japan, Korea, China, they've each launched very comprehensive value-up programs since around 2023-24 to boost performance. We've actually done a deep dive on this, and if you look at our research report today on the newsletter, you'll actually get to see that. Now, all three focus on three things. First is improving capital efficiencies above cost of capital. Two, enhancing shareholder returns and investor confidence. And three, strengthening governance and disclosures. Now, also these programs oblige the boards to set time-bound profitability and valuation targets, to monitor COE, WACC spreads, and also increase shareholder engagement. Now, all of this stuff has actually worked. Post-reform, the North Asian markets have averaged about 25% index gains versus around 13% before these reforms actually took place. So, you can see that the market does reward this. Things like public disclosure, investor dialogue, and name and shame mechanisms have actually improved corporate responsiveness. Now, if you look at Singapore, there's a very big gap. Over 55% of listed companies in Singapore trade below one-time book, and 46% actually hold net cash positions. So there's massive, widespread underutilized capital. Plus, there's also long-standing issues in terms of corporate governance and low capital returns, which have actually kept the small and mid caps from not really re-rating very much. So now MAS is saying that they will unveil some value up program in November. Now, if this is anything to go by, what the Japanese, the Koreans, and the Chinese have done, we think there are some great opportunities to sustain the small and mid-cap rally that we have seen. Now, to get ahead of this, we've screened the 100 largest SGX stocks with at least 20% of their market cap in cash. Because we think that cash gives management the best optionality to deliver shareholder returns. We've actually devised some target parameters for value up qualifications. Price to book has to be above 1 time, dividend payout ratio of more than 30%. They've had to have had a active share buyback program over the last 12 months, and ROE to cost of equity and ROIC to WACC spreads at least above 2 percentage points. Now, when we filter the original 100 stocks with these parameters, and we look for the companies that are just below these parameters, because we think that they'll have the shortest paths to reform if MAS makes them reform going forward. We've got 15 such names. Notable names include Bukit Sembawang, Hock Leang Seng, OCA International, Stamford Land, Tiang Moon, and Wing Tai. I mean, the whole list is available on your screen right now. We also screen a secondary group. These are 19 names that already kind of meet or exceed the minimum criteria for value up. And we think that, should MAS announce some, reforms, these companies will benefit first. Sorry, 18 names, sorry. And the notable names there include China Sunshine, Hourglass, iFast, Lamchong, Olam, Stratco, and two stocks we cover, Sheng Siong and HRNet. Sherry?
Sure. Thank you, Thilan. Okay, next, we'll move on to the banks. The Singapore banks will report 3Q next week, the result next week. And what are you expecting? What will you be looking out for?
Yeah, so DBS and UOB are out on the 6th of November, and OCBC is out on the 7th of November. We expect flat to slightly weaker earnings. Third quarter results should come in flat to slightly weaker on a quarter-on-quarter basis. And NIM compressions will continue. We did see SORA falling about 60 basis points in the quarter. We were actually looking at SORA kind of being flat this quarter, and that hasn't happened, so that you'll see a bit of pressure on NIMs. We're also looking for loan growth recovery. Domestic loans, particularly things like mortgages, SMEs, construction, should show improvement given the fact that there's a construction boom that is happening, and private housing is actually overall property sales have been very, very strong. But we do think that Hong Kong and China will stay soft. Non-interest income will be the primary catalyst for earnings this quarter. Wealth management should actually see pretty strong growth, particularly as customers move from fixed deposits to more higher risk products. Plus, we think that trading income, FX, brokerage should also see decent growth this year. Now, asset quality, we're expecting it to be fairly stable. Credit costs should remain low. There are some concerns like what we saw with the US banks when it comes to private credit exposure, as well as North Asia commercial real estate, but we don't think there's going to be too much contagion for the Singapore bank. So overall, slow growth, but overall asset quality holding up quite well. Dividend surprises, we're not really expecting much this quarter. So not really looking to change our neutral sort of view on the sector right now.
Understood. Then I know that you have always liked DBS. Is it still the same, among your picks and preference for the banks?
Yeah, so I think our preference for DBS still remains. I mean, they've got scale, they've got a very strong wealth management business. So I think all of those will help them. Plus the fact that they've got one of the lowest cost funding as well. So all of these coming together will help DBS pull ahead of the other two banks. Now, having said that, we think UOB also has a chance of surprising on the upside during this quarter. They have been putting on a little bit more risk when it comes to trading income, so that'll help. Plus, a lot of their margin compression, a lot of the integration issues with the Citibank franchise are very well known, so that's in the price. So anything that they do positively should enable them to surprise on the upside. OCBC, I think you're still in the middle of this leadership transition, so I think you're going to be we're not we remain a hold on that stock.
Sure. All right. Thanks, Dylan, for coming on the show. Next, we'll move on to Husaini. Husaini, you downgraded C recently. What made you change your opinion that made you downgrade C?
Thanks, Jarek, for having me. So we downgraded C to a non-consensus hold because we now see the margins outlook as less clear in the near to medium term. So here is what has changed. Shopee, which is C's e-commerce business, earlier Shopee was raising seller fees while it's larger scale, and the ads revenues, which is a very high margin business, is all growing. On the other hand, competition in ASEAN remains quite rational. So factoring all these things, we were expecting margins to keep rising. However, management now plans to reinvest more for growth, meaning Shopee's margins may fall in second half of this year, and improve more slowly going into next year. And this is below what market expects. Similarly, fintech and gaming margins may also dip as the company increases spending. So, in short, growth remains solid for C, but with less visibility on margins, we have turned more cautious and moved to hold.
Sure. Thanks, Husaini. And seeing that your EBITDA forecast is 6 to 8% below consensus, and also your whole core is also quite non-consensus, but just wondering, why not the sell core instead of a whole in this
Yes,
case?
sure. Good question. See, our EBITDA forecasts, as you rightly pointed, are indeed 6 to 8% below market expectations. However, we are not calling a sell because first, the stock has already corrected a bit. So some of the margin weakness is already reflected in the price. Second, growth remains strong. So e-commerce is growing around 25% and fintech is even growing faster. And third, ASEAN's online e-commerce as well as fintech penetration is still low, meaning there is plenty of room for long-term growth. In short, the growth story is intact, but we downgraded to hold mainly because the margins outlook is uncertain in the medium term.
Sure, so more of a wait and see for margin recovery and see whether next time, will the margins be better to justify its valuations for more uplift. Is that correct?
Yes, that's absolutely correct. That's how
Okay,
we
thank you
look
so
at it.
much. Got it. Thank you so much, Husaini. Next, we'll move on to Marco Polo. Yeah, so basically for Marco Polo Marine, they have announced quite a slew of announcements in the last few weeks. The one of them being that they will start to contract a new CSOV at its Batam shipyard starting second quarter of 2026 and delivery plan for 4Q28. They will also buy two new AHTS vessels worth about 34 billion US dollars, which will increase its fleet size from 19 to 21 by the end of 2026, FY26. We also expect these vessels to contribute significantly to its PATMI from FY27 to FY30 when they are ready. And next, the valuations across the peers in the small mid-cap space like Pac Radiance and ASL Marine so on have also re-rated higher in the last few months, partially also due to this EQTP program. And as a result, we are actually maintaining buy on MPM with a higher TP of 11 cents based on a higher 13.5 times FY26 PE from 11 times. We do think that EPS could potentially increase further. There's also a potential at least once the vessels come on board, but we are only waiting to revise our earnings once the vessels come aboard for more clarity and more certainty. So there's still earnings uplift potential from our numbers. For now, we are just basing it on a higher TP, on a higher PE for FY26, being more conservative on 11 cents. But we do think that, the next catalyst could also potentially be the Taiwan listing, which could boost its valuations even further because similar peers in Taiwan are trading at a much higher valuation as compared to that of Singapore. As a result, we still like Marco Polo and we'll maintain buy on it. So that's all for today. Thank you so much for joining us on the show and see you guys next week. Goodbye.